Did you know that 90% of traders fail despite having access to the same technical analysis tools as professional traders? They study support and resistance, learn moving averages, master candlestick patterns, yet they still lose money consistently. The reason isn't what you think. The problem isn't that technical analysis doesn't work. The problem is that your brain is sabotaging your charts every single day, and nobody is teaching you how to stop it. Here's the shocking truth: traditional trading education teaches technical analysis and psychology as separate subjects. You learn to identify a double bottom pattern in one lesson, then learn about fear and greed in another. But in real trading, these forces collide every single second. When you see that perfect breakout setup, your brain doesn't analyze it objectively. Instead, it filters everything through your current emotional state, your recent trading history, and dozens of unconscious biases that completely distort what you're seeing on the chart. Let me show you what this looks like in practice. Take Sarah, a beginner trader who learned textbook technical analysis. She spots what appears to be a perfect bullish flag pattern on Apple stock. Clean breakout, strong volume, everything looks perfect. But Sarah just came off 3 losing trades in a row. Her brain, desperate to recover losses, sees this setup as her salvation. She ignores the fact that the broader market is showing weakness, misses the bearish divergence on the RSI, and sizes her position way too large because she needs this trade to work. The result? What should have been a small, controlled loss becomes a massive account blow-up because her emotions completely hijacked her technical analysis. This separation between psychology and technical training is costing traders everything. You can memorize every chart pattern, but if you can't recognize when your emotional state is distorting your analysis, you'll keep making the same devastating mistakes. Today, we're going to fix this forever by showing you exactly how your brain sabotages your charts and giving you the integrated system that professional traders use to stay objective. Confirmation bias is the silent killer of technical analysis. Your brain actively searches for information that confirms what you already believe while ignoring contradictory evidence. Here's how it destroys your chart reading. You enter a long position on Tesla after identifying an ascending triangle. Instead of objectively monitoring all signals, your brain starts cherry-picking only the bullish indicators. You see every small bounce as confirmation, while dismissing volume divergence and bearish candlestick patterns as noise. Professional traders combat this by using what I call the devil's advocate method. For every bullish signal you identify, you must actively search for 3 bearish counterarguments. This forces your brain to process all available information, not just what supports your existing position. Fear of missing out doesn't just make you chase momentum, it literally changes how you interpret support and resistance levels. When a stock is rallying and you're on the sidelines, your brain starts seeing support where none exists. You'll look at a minor bounce off a moving average and convince yourself it's strong support, because you desperately want an entry point. In reality, you're seeing what you want to see, not what's actually there. The antidote is the support strength test. Before calling any level support, ask yourself, would I identify this as support if I had no position and no desire to enter this stock? If the answer is no, step away. Anchoring bias locks your analysis onto specific price points, usually recent highs or lows, causing you to miss real-time changes in market structure. You bought Amazon at $150, so you keep seeing $150 as cheap even after the fundamentals have deteriorated and technical analysis shows continued weakness. This bias makes you ignore new support and resistance levels while clinging to outdated reference points. Your charts might be showing a clear downtrend with lower highs and lower lows, but your brain keeps anchoring to that old high, waiting for a bounce back to fair value. Recency bias causes you to give disproportionate weight to the most recent price movements while ignoring longer-term context. After 3 consecutive green days, you start seeing every pullback as a buying opportunity, even if the broader trend is clearly bearish. This shows up in chart analysis as pattern distortion. You might identify a cup and handle formation when you're really looking at random noise within a larger distribution pattern. The recent price action feels so significant that it overshadows the bigger picture. Let me show you these biases in action with real chart examples. Here's a trader analyzing Microsoft stock after a series of winning trades. Notice how confirmation bias makes him see bullish divergence in the MACD that isn't really there. His recent success creates overconfidence, leading to pattern recognition that's more wishful thinking than technical analysis. Compare this to the same chart analyzed by a trader in an emotionally neutral state. The analysis is completely different, more conservative, more objective, and ultimately more profitable. Fear doesn't just make you hesitant to take trades, it fundamentally alters how you interpret resistance levels. When you're afraid, your brain amplifies every sign of resistance while minimizing evidence of strength. A stock approaches a previous high, and instead of seeing a potential breakout, your fearful brain sees an obvious resistance level that's impossible to break. You start identifying micro-resistance levels that don't exist, turning minor price hesitation into major technical barriers. This emotional distortion causes you to exit winning trades prematurely or avoid high-probability setups entirely. You're not seeing the chart objectively, you're seeing it through the lens of fear. Greed creates the opposite problem, it makes you see trend lines and support levels that simply aren't there. When you're in profit and greed takes over, your brain starts drawing increasingly aggressive trend lines to justify holding positions longer. You'll connect two random points and call it a trend line, or identify a minor bounce as strong support, because you want the trend to continue. Greed makes you ignore obvious distribution patterns and volume divergences because acknowledging them would mean taking profits. Anxiety destroys your ability to recognize valid chart patterns by making you see threats everywhere. Under anxiety, every small pullback becomes a failed breakout, every consolidation becomes distribution, and every minor resistance level becomes insurmountable. This emotional state causes you to second-guess valid setups and exit positions based on noise rather than genuine technical analysis. You'll abandon perfectly good trades because anxiety convinced you that normal price action was actually a sign of impending collapse. Euphoria might feel good, but it's one of the most dangerous emotional states for chart analysis. When you're euphoric, usually after a series of wins, your brain starts ignoring risk entirely. You stop seeing valid resistance levels, dismiss volume divergences, and identify continuation patterns where none exist. Under euphoria, every consolidation becomes a bull flag, every pullback becomes a buying opportunity, and every breakout becomes the start of a major move. Your risk assessment becomes completely compromised. Let me show you the same chart analyzed under different emotional states. Here's a trader analyzing Netflix stock while calm and objective. Notice the conservative trend lines, realistic price targets, and proper risk assessment. Now here's the same chart analyzed by the same trader under emotional stress after a big loss. Everything changes, the trend lines become more aggressive, resistance levels are ignored, and risk management goes out the window. It's the same data, but the emotional state creates a completely different interpretation. This is why professional traders use systematic approaches that work regardless of emotional state. They know that emotions will always try to hijack their analysis, so they build safeguards into their process. The FOMO revenge cycle is the deadliest pattern in trading psychology, and it starts with misreading breakouts. When you're watching a stock rally without a position, FOMO makes you see breakouts where none exist. You'll identify a breakout from a consolidation that's actually just random noise within the range. Or you'll see a flag breakout that's really just a brief squeeze before the stock rolls over. FOMO doesn't just make you chase price, it makes you misinterpret the very signals you're using to justify the chase. After the FOMO trade fails, revenge trading kicks in. Now you're not just misreading charts, you're forcing patterns that don't exist. You desperately want to recover your losses, so your brain starts creating chart patterns out of thin air. You'll see a double bottom in what's clearly a downtrend, or identify a inverse head and shoulders in random consolidation. Revenge trading makes you see what you need to see rather than what's actually there. Here's how the cycle spirals out of control. The FOMO trade based on false pattern recognition loses money. This creates emotional stress that distorts your next analysis. The revenge trade based on forced patterns loses even more money. Now you're in deeper emotional trouble, leading to even worse chart analysis. Each step in the cycle compounds the problem. Your emotional state gets worse, your chart analysis becomes more distorted, and your losses increase. This is how traders go from small mistakes to account destruction in just a few trades. Let me show you this cycle with a real trading sequence. Day 1, trader sees Apple breaking out during market hours and jumps in with FOMO. The breakout fails by market close. Day 2, revenge mode kicks in. The trader forces a reversal pattern that doesn't exist and doubles down. Day 3, even bigger losses lead to all-in trades based on completely imaginary chart patterns. This trader went from one small FOMO mistake to a 40% account drawdown in 3 days, all because emotional states kept distorting chart analysis. The technical knowledge was there, but the psychological awareness was missing. The moment you realize you've made an emotional trading decision, you must implement immediate intervention protocols. First, close all trading platforms. I'm serious, close them completely. Your brain is compromised right now, and continuing to look at charts will only make things worse. Next, physically step away from your trading setup. Go for a walk, do some exercise, or practice deep breathing. You need to create physical distance between yourself and the emotional trigger. This isn't optional, it's emergency psychology. Here's the exact 5-minute reset protocol that professional traders use. Minute 1, acknowledge the emotional state without judgment. Say out loud, I notice I'm feeling angry, fearful, or greedy right now. Minutes 2 to 3, practice box breathing. Inhale for 4 counts, hold for 4, exhale for 4, hold for 4. Repeat this cycle to reset your nervous system. Minutes 4 to 5, review your trading rules without looking at any charts. Remind yourself of your systematic approach and why you created these rules in the first place. Only after completing this full reset should you even consider looking at charts again. Before analyzing any chart or making any trading decision, you must check your emotional state. Ask yourself 3 questions. What emotion am I feeling right now? How might this emotion be affecting my chart analysis? Would I make the same analysis if I were completely neutral? If you can't honestly answer these questions, you're not ready to trade. Professional traders never analyze charts while emotionally compromised because they know it leads to distorted interpretation. When emotions are running extremely high, implement emergency protocols. Protocol 1, the trading lockout. Set a rule that you cannot enter any new positions for 24 hours after a major emotional trading decision. Protocol 2, the buddy system. Have a trading partner who can review your analysis when you're emotionally compromised. They can spot the bias you're blind to. Protocol 3, the journal review. Before any trade, write down your emotional state and your reasoning. The act of writing forces objectivity and often reveals emotional distortion before you act on it. Here's the systematic approach that eliminates emotional bias from chart analysis. Step 1, Emotional State Assessment. Check and document your current emotional state before looking at any charts. Step 2, Time Frame Hierarchy. Always start with higher time frames and work down. This prevents you from getting lost in emotional noise. Step 3, the Devil's Advocate Analysis. For every bullish signal, identify 3 bearish counterarguments. For every bearish signal, find 3 bullish ones. Step 4, Pattern Validation. Every pattern must meet specific, objective criteria. No exceptions based on feeling or recent performance. Step 5, Risk Assessment Reality Check. Calculate risk before considering reward. If you can't clearly define your stop loss, you're not ready to trade. Your immediate action plan. 1. Print out the emotional state check questions and keep them next to your trading setup. 2. Set up the 5-minute reset timer and practice the technique daily. 3. Create your bias-free chart analysis checklist and follow it religiously. 4. Establish emergency protocols now, before you need them. 5. Start documenting your emotional state before every trade. Remember, professional trading isn't about eliminating emotions, it's about recognizing when emotions are influencing your analysis and having systems in place to maintain objectivity. The integration of psychology and technical analysis isn't just a nice-to-have skill, it's the difference between consistent profitability and joining the 90% of traders who fail. Master this system, and you'll finally read charts the way professional traders do, objectively, systematically, and profitably. Your trading account depends on it.